What a month, what a week, what a day. Just when you thought the stock market was an unstoppable rocket to the moon, we get a day like Friday, August 29th. The Dow Jones and S&P 500 hit record all-time highs, and then in a single session, slammed the brakes on. So what just happened? Was this a blip, or is it a warning sign of something bigger on the horizon? We're going to break it all down. The shocking tech sell-off, the confusing new inflation data, and the massive decision the Federal Reserve has to make next. If you want to understand the signal through the financial noise, you need to watch this entire video, because the details are what separate smart investors from the crowd. Let's set the stage. August 2025 was, by all accounts, a fantastic month for the stock market. It was the fourth winning month in a row. The Dow surged over 3%, its best month since June. On Thursday, the 28th, the Dow closed at its highest point in history. Everything looked incredible. But then came Friday. The S&P 500 dropped 0.6%. The Dow fell 0.2%. And the tech-heavy Nasdaq, it tumbled 1.2%. It was a downbeat end to a spectacular month. Now, a single down day isn't a crash, but it's the reason for the drop that's so important. This wasn't panic selling, it was a calculated, cautious pullback. Investors were taking profits off the table, looking at these record-high prices and asking themselves, is this sustainable? And the answer to that question lies in the tech sector. The Nasdaq's drop was 6 times bigger than the Dow's. That tells us exactly where the trouble started. The artificial intelligence boom has been the engine of this entire stock market rally. Companies like Nvidia have been the stars. But on Friday, that engine stalled. Take Dell, for example. Their stock was the worst performer in the S&P 500, plummeting nearly 9%. Now, here's the crazy part. They actually reported great second quarter revenue. It beat all the expert estimates. Normally, that would send a stock soaring. So why did it crash? Because investors have stopped looking at the past. They're only looking at the future. And Dell's management warned about margin pressures and weakness in PC demand. That's all it took. The good news from the past was irrelevant. The warning about the future was everything. We saw the same thing with Marvell Technology, a semiconductor company. Their stock cratered by a staggering 18.6% because their future guidance wasn't perfect. This is a market that is priced for perfection. Any sign of a slowdown is being punished severely. And it wasn't just them. The AI giants, Nvidia, Broadcom, Oracle, all fell. Why? Because the AI hype story is getting more complicated. The market is starting to ask tough questions. Questions like, is AI actually profitable right now? The costs of developing this technology are astronomical. Are the revenues keeping up? Then you have new competition. Reports surfaced that the Chinese giant Alibaba has developed its own advanced AI chip. The idea that a few companies would dominate the AI space forever is being challenged. More competition could mean lower prices and smaller profits in the future. The stock market is just now starting to factor in that risk. Before we get into the even bigger story lurking behind this tech sell-off, do me a favor. If you're getting value from this breakdown, hit that like button. It tells the YouTube algorithm that this is a conversation worth having, and it helps us bring this analysis to more people just like you. Thanks, I appreciate it. Okay, so while everyone was watching the tech stocks tumble, a crucial piece of economic data dropped: the PCE price index. This is the Federal Reserve's favorite way to measure inflation, so when it comes out, everyone on Wall Street pays attention. The headline number was, fine. Inflation was 2.6% year over year, exactly what economists predicted. No surprises there, but the devil, as always, is in the details. The number that really matters is core PCE. This strips out volatile food and energy prices to show the underlying inflation trend, and that number was not fine. Core PCE rose to 2.9%, the highest it's been since February. Think about that. While we've made progress from the 7% inflation peak a few years ago, we are still a long, long way from the Fed's 2% target. And the inflation that's left is the sticky kind. Goods prices are actually falling a bit. But the cost of services, things like rent and wages, is still climbing. This is what economists call the last mile problem. Getting inflation from 7% down to 3% was the easy part. Getting it from 2.9% down to 2% is going to be a tough, slow grind. And that creates a massive headache for the one institution that matters most right now, the Federal Reserve. This is where it all comes together. The stock market has been rallying for months on one simple hope, that the Federal Reserve is about to start cutting interest rates. Lower rates make it cheaper to borrow money, which is like rocket fuel for stocks. And the market is convinced it's happening. Traders are pricing in an 87% chance of a rate cut in September. Why? Because Fed Chair Jerome Powell and other officials have been hinting at it. They've been pointing to a softening labor market as their excuse to start cutting, even with inflation still so high. But look at the situation they're in. It's a credibility trap. On one hand, if they cut rates like everyone expects, they risk looking like they've given up on their 2% inflation target. It could look like they're caving to pressure from the market or politicians. That could damage their credibility for years to come. On the other hand, if they look at this sticky 2.9% inflation and decide to hold rates steady, they will defy the market's 87% expectation. That would cause a violent shock to the system. Stocks, bonds, everything would have to be repriced in an instant, and it would not be pretty. This is why the next jobs report is so important. The market is now in a bizarre bad news is good news phase. Investors are actively hoping for a weak jobs report because they see it as the final green light for the Fed to start cutting rates and keep the party going. A rally built on the hope of a weakening economy is a fragile rally indeed. The dip on Friday was the market just starting to realize the risk that the Fed might choose its long-term credibility over the market's short-term desires. So, we've talked about Wall Street, but how does this ripple out and affect the real world, your world? First, expect more volatility. This tension between inflation data and the Fed's decision is going to make the stock market jumpy. Every new piece of data will be overanalyzed. Second, this has real consequences for companies. They're getting squeezed. Inflation is raising their costs for materials and labor, but a slowing economy means they can't easily raise their prices without losing customers. This is that margin pressure Dell talked about, and it's a huge challenge. Companies will have to focus on being more efficient rather than just growing at all costs. And finally, it affects you directly. Consumer sentiment is already falling because of heightened concerns about prices and the economy. A market pullback, even a small one, hits your 401k and investment accounts. And here's a key detail. Even if the Fed cuts its short-term rate, long-term borrowing costs for you could stay high. The 10-year Treasury yield, which influences mortgage and car loan rates, actually went up on Friday. So, the cost of buying a house or a car might not get cheaper anytime soon. This isn't just a US story either. What happens with the US economy and the Fed impacts the entire globe. We're seeing concerns about US tariffs affecting other countries like Canada, adding another layer of uncertainty to the global financial picture. So that's the clarity behind the recent stock market jitters. It's a complex story of a tech sector reality check, stubborn inflation, and a Federal Reserve walking a very dangerous tightrope. It's not a signal to panic, but it is a signal to pay close attention. Now, you have a clearer picture of the forces at play, but I want to know what you think. What's your biggest question after seeing this breakdown? Is the market overreacting, or is this the start of a bigger trend? Leave a comment below with your biggest takeaway. I read every single one. And if you believe in making finance make sense, join our community by subscribing. We post deep dives like this every week to help you cut through the noise. For more clear insights, check out this playlist right here. Keep building your sense.